Welcome to Breaking News to Trading Moves. Today we're focusing on a really instructive piece of recent market action. It all centers around the release of Elastic's fiscal Q2 2026 results.
That's right. And this event, it really gives us a precise roadmap for how quickly capital can abandon one idea and just immediately seek refuge somewhere else.
And in this case, it's often an entirely different and usually larger business models.
That's really the core of what we're looking at here. A quarterly report from a high-profile software company like Elastic, especially one that's, adjacent to the AI space, doesn't just affect that one company.
It's more of a catalyst.
It's a very specific catalyst. It forces this immediate reallocation of capital, and it creates these very clear, very rapid winners and losers all across the tech ecosystem.
The headline here is just impossible to ignore. Elastic, which trades under the ticker ESTC, saw a really sharp decline, about 16% right after their report.
A forceful repricing event.
Yeah.
And it was all driven by a change in what the market expected for the future.
And that kind of extreme price movement is what really demands our attention today. We need to look past that initial shock.
And analyze two things. First, why did the market react so severely to results that, on paper, looked pretty sound?
Right. And second, and this is the key part for our conversation, where did that money go?
We're going to trace the money. We want to identify the companies that benefited from this rotation, the winners, and then also those that felt that sympathetic pressure, the losers.
Okay, so let's start with the report itself, because this is where you see that contrast between the actual performance and what the market expected. It's really clear here.
It is, and if you look at the raw metrics, Elastic's Q2 performance was, by any traditional standard, pretty solid.
Absolutely. If you just strip away the context of, the stock's valuation, the company delivered strong results.
Yeah, let's go through them. Elastic reported revenue of $423 million. And crucially, that's a 16% year-over-year growth rate.
And their operational efficiency looked good, too. The company was profitable, at least on a non-GAAP basis. Their earnings per share, or EPS, came in at 64 cents.
Which did comfortably beat the consensus expectations from Wall Street analysts. So you're checking the boxes so far?
You are. And to compound that positive news, management gave a vote of confidence in their forward trajectory. They slightly raised their full-year revenue guidance.
Right, they bumped it up. They're now projecting the top line to land somewhere between $1.715 billion and $1.721 billion.
So if you just look at the numbers, it sounds like a healthy company. Double-digit growth, exceeding profitability targets.
So we have an EPS beat, sustained double-digit growth, and a raised outlook for the full year.
Yet the stock gets punished, a 16% drop. Why does this happen? It just signals a huge disconnect between what the company delivered and the valuation framework the market had for it.
That contrast is the heart of the matter. These metrics, while they were numerically successful, they just weren't enough to sustain the valuation multiple that Elastic commanded.
The market looked at this delivery, which was, again, technically a beat,
and saw as failing to meet the, let's call them the unwritten expectations for growth acceleration that are priced into these high multiple software stocks.
Let's break down the specific triggers then. What caused this massive flight of capital and that steep 16% markdown?
The primary trigger was, without a doubt, growth deceleration.
Deceleration.
Yeah. That 16% year-over-year growth rate, while it's fine in isolation, it represented a cooling off compared to the pace in previous quarters.
And when a company's trading at, 8, 10, maybe even 12 times its forward revenue?
Which is a multiple that's only justified by assuming they'll keep growing at, say, 25% to 30% plus.
Then any evidence that that growth curve is flattening out or slowing down?
It's interpreted as a reason for an immediate dramatic contraction of that valuation multiple. It has to happen.
So it's the difference between trading on what's happening now versus trading purely on the expectation of what's going to happen in the future. And when that expectation gets questioned, the price just falls instantly.
Exactly. And the second trigger, that came from the commentary from management during their call. They gave some specific color on deal timing issues that caused some concern for investors.
Right. They specifically pointed to some slippage that was linked to the October U.S. government shutdown. Now, that sounds like an external, maybe even a temporary factor, but how does the market interpret something like that?
The market translates that. It translates external slippage into, underlying demand weakness or maybe internal execution risk.
So even though it's the government's fault, so to speak.
It doesn't matter. If a large government deal gets delayed because of politics, investors start to worry that it's masking a deeper reluctance from the customer to spend, or it's a sign of increasing budget scrutiny.
And for a company like Elastic, whose pricing is built on consumption on usage, any hint that customers are delaying purchases or, actively optimizing their costs is a major red flag.
It is. It indicates the underlying business model is more vulnerable than people previously assumed.
So the deal wasn't even lost, it was just delayed. And that was enough to signal fragility in the model.
Precisely. The market is basically saying, okay, if you're vulnerable to these non-fundamental temporary external issues like a government shutdown, how robust is your demand trajectory really going to be when a genuine economic downturn hits?
And that question is the reason for the 16% markdown.
It is. So this analysis has, far wider implications for the broader software sector, especially for those companies tied to the cloud economy and AI infrastructure.
The lesson here is pretty harsh but clear.
It is. Elastic wasn't viewed as a broken business, but its failure to meet those peak acceleration expectations, that triggered a very rapid reassessment. When expectations are priced for flawless execution, any evidence of deceleration or lumpiness in consumption, it just justifies a rapid exit.
So the valuation multiple had to contract, and it had to contract instantly to reflect a lower, more sustainable growth path, and that's what we saw.
Yeah, and this immediate pressure, it doesn't just stay with Elastic. It serves as an alarm bell. It signaled to traders that they have to anticipate moves across the whole observability sector and that wider group of consumption-based software models.
So capital has to quickly rotate toward vendors that are perceived as more resilient, more stable, or maybe ones offering a more consolidated solution.
Let's follow that money trail. Where did the capital that fled from Elastic's valuation risk find its new home?
We can pretty clearly track that capital rotation into three distinct categories of beneficiaries. The first, and maybe the most intuitive group, are the massive platform players.
We call them the cloud hyperscalers, and they act as an immediate flight to safety trade. The reasoning is pretty clear. Volatility in a dedicated, specialized vendor like Elastic prompts both enterprises and traders to seek refuge in the largest, most entrenched infrastructure providers out there.
Why does Elastic's specific weakness, in search, logging, and observability funnel money directly to giants like Microsoft and Amazon?
It's driven by two main factors: risk aversion and vendor consolidation economics.
Okay, what do you mean by that?
Well, when an enterprise CIO sees Elastic stock drop 16%, it introduces doubt. Doubt about the long-term stability or maybe the cost efficiency of that specialized tool. The immediate default is often to consolidate.
So they say, look, we're already spending billions with Microsoft Azure or Amazon Web Services or Google Cloud.
Exactly. They say, instead of adding risk with this specialized vendor, let's just leverage the native logging, search, and AI services those platforms already offer.
So the hyperscalers end up absorbing spending that might have otherwise gone to these more niche tools. And at the same time, the enterprise simplifies its own vendor management. It's a win-win for them.
It is. It reduces vendor complexity. It often lowers the overall long-term infrastructure costs, especially by minimizing those expensive egress fees between different vendors. And it eliminates the risk that's associated with depending on a single mid-cap company whose shares just showed extreme volatility.
They offer stability, scale, and integration.
That's the package. So the companies benefiting here are, the usual suspects in cloud infrastructure. You've got Microsoft, ticker MSFT, Amazon, ticker AMZAN, and Alphabet, which is Google, ticker GOOGL.
They are the immediate refuge.
They capture the capital because they capture the spending. They capitalize on that enterprise tendency to consolidate budgets toward providers of critical, durable infrastructure, especially when a specialized vendor starts to look a little less stable.
Okay, so let's move to the second category of winners. This would be the security platforms that are actively consolidating services. This seems like another area where the market's desire for simplified vendor relationships is really paramount.
This is a robust, accelerating trend. It's the merging of what we call CCOP security operations and ITOPS IT operations. Enterprise customers are just fed up with fragmented software platforms.
They want tighter AI and workflow automation that spans both security monitoring and general log management.
Desperately. An Elastic situation, this very public display of volatility, it only accelerates the urgency for companies to adopt these all-in-one platforms for their centralized budgets.
So when a dedicated log analytics vendor like Elastic shows a momentary flaw, or even just a potential risk in its consumption model, the argument for platform consolidation just gets a lot stronger.
Absolutely. Why manage separate bills, separate contracts, separate APIs when you can get a robust, unified security and observability stack from a single provider? It just makes sense.
So who is positioned best to absorb this demand for consolidation?
We're looking at vendors that have moved pretty aggressively beyond their core security offering and into data and observability. This includes names like Palo Alto Networks, ticker PANW,
Okay.
also CrowdStrike, ticker CRWD, and even Cisco Systems, ticker CSCSEO.
Let's talk about CrowdStrike for a second. They've successfully built out their Falcon platform to include a lot of observability capabilities, haven't they?
They have. And Palo Alto Networks is executing a very similar platform approach across multiple security domains. They're all trying to be that single source of truth.
These companies offer what traders sometimes call the single throat to choke.
It's a blunt phrase, but it's very accurate in the enterprise world. It means accountability. When something goes wrong, the CIO wants one vendor to call, not five.
Makes sense.
And Cisco, it benefits from these deep, established enterprise integrations. It's leveraging its huge installed base to push a more unified platform story. They all win when these specialized point solutions start to look fragile.
All right, let's look at the third group of winners, the large cap enterprise software refuges. These are the established platforms that offer predictability, and they offer it precisely because they aren't tied to that high volatility consumption model.
These are the pillars of the software world. They offer durability. When traders are forced to exit a rapid, sharp sell-off in a mid-cap, usage-based name like Elastic that displaced money, it doesn't just vanish. It rapidly seeks out companies known for reliability and subscription stability.
So they're looking for platforms with inherently stickier business models and steadier, more predictable growth trajectories. Explain why they're stickier than a company like Elastic.
The key difference is revenue predictability. Elastic, and some peers we'll talk about later, relies on usage. If a customer is cost optimizing, usage drops and the revenue immediately contracts.
But companies like ServiceNow, Salesforce, and Oracle are different.
Very different. They primarily sell fixed multi-year subscriptions. It's based on the number of seats or a flat platform access fee. Once a customer commits to, say, 5,000 seats of ServiceNow for their IT workflow management, that revenue is locked in. It doesn't matter how many logs they decide to process that month.
So their business models are kind of insulated from a customer's month-to-month cost optimization efforts.
Precisely. These large caps have clear, stable subscription platforms, and they've also established clearer narratives around how they monetize AI. Often it's by charging a premium for an AI copilot feature that's added to an existing seat license.
Which makes them appear as far more durable options during times of sector-specific volatility and perceived risk in that consumption model.
That's it. So the specific companies benefiting from this flight to quality and subscription predictability. You've got ServiceNow, ticker NOW,
Right.
Salesforce, ticker CRM, and Oracle, ticker ORCL. They are the receivers of money that is fleeing that usage volatility. Their scale and highly predictable recurring revenue profiles make them excellent safe harbors for capital seeking continued exposure to software growth, but without the immediate execution risk that Elastic just highlighted.
Okay, now we have to turn to the other side of the equation. Elastic's results didn't just cause its own 16% decline. The report acted like a contagion, creating immediate downward pressure across several related software cohorts.
Right.
So we should start with the most obvious victims, the direct competitors, the observability and log analytics pure plays.
This is pure reflexive sympathy selling. It's driven by the immediate assumption of shared execution risk. Elastic's report confirmed a deep-seated worry that investors have about the observability space.
And that worry is?
That usage growth can be irregular. It can be lumpy. And it's fundamentally unpredictable when enterprise customers dedicate serious resources to optimizing their cloud expenditures.
And since cloud optimization and cost control remain, the top mandate for CIOs everywhere, this vulnerability is not a trivial concern.
It is the most critical risk. The moment one major vendor in the space confirms that deal timing is an issue or that consumption growth has slowed, the market immediately projects that worry onto the entire cohort.
So investors just assume that the underlying customer behavior tightening budgets is affecting everyone equally.
Exactly. And that reading instantly puts downward pressure on the valuations of all the companies whose growth depends heavily on monitoring and logging consumption volumes. It's a proactive move based on anticipated shared weakness.
So if Elastic, ESTC, is experiencing this lumpiness and deceleration, then its peers like Datadog, ticker DDOG, and Dynatrace, ticker DT, are immediately scrutinized.
Right. Traders don't wait for their individual earnings reports. They just proactively de-risk. They assume that similar underlying market dynamics, slowing usage, budget scrutiny, are affecting everyone in the category.
Let's talk about that specific grouping for a moment, because Datadog, for instance, has been aggressively diversifying its platform. They're moving beyond pure log management into security and APM. Is it really fair to lump them in so readily with Elastic?
That's a necessary challenge. And while Datadog's platform diversification is undeniable, and it does provide some insulation, the core market reaction, at least in the short term, is often blunt.
It's not very nuanced.
Not at all.
Yeah.
The first reaction is to sell the whole cohort, because the perceived weakness in the consumption model is seen as paramount. So even if Datadog or Dynatrace DT have better execution or a slightly different mix of business, they still generate a substantial portion of their revenue from customers who pay based on the volume of data they ingest.
And Elastic's report just confirmed that the faucet of data ingestion can be turned down by the customer, and that shared risk weighs heavily on all of them.
That's the key. Okay, so let's move to the second category, feeling the pressure. Consumption-based AI and data software. Now, this group isn't necessarily in the observability market, but they share the same critical pricing model risk.
Right, so this is the wider market reaction. It's a reaction to the generalized vulnerability of the consumption-based revenue model itself.
Elastic's model relies heavily on customer usage. That means its revenue is highly elastic. It stretches up very quickly when usage accelerates, but it can snap back violently when customers decide to optimize.
And when the market sees any hint of slower consumption patterns from one usage-based vendor, that generalized fear spreads rapidly to others, regardless of the industry they happen to serve.
It does. Investors recognize that the mechanism of cost optimization is transferable. It applies across different usage models. So if a CIO is actively reducing log processing volumes to save money on Elastic, that same CIO is probably looking at their spend on other high-volume data platforms.
And investors just proactively reduce their exposure to other companies that rely on similar consumption mechanics, even if those companies' current results are perfectly robust.
Exactly. So we're talking about companies whose financial health is deeply dependent on the volume of data that's processed or consumed by their clients.
That's the definition of model risk here.
It is. This includes major data platform players like Snowflake, ticker SNOW, the database company MongoDB, ticker MEDB, and the data streaming company Confluent, ticker CFLT.
So all of these names derive their revenue largely from the volume of processing or storage or utilization by their clients.
Correct. And Elastic's bad news becomes a systemic warning about the entire consumption methodology being vulnerable to enterprise budget scrutiny.
It's a powerful illustration. The market is viewing the entire concept of usage-based revenue as potentially fragile, especially during any kind of economic uncertainty.
The product difference, observability versus data warehousing, it becomes secondary to the revenue mechanic. If the customer can easily control the volume they pay for, then the vendor carries the execution risk of the customer's budget tightening.
Okay, our final category of losers. This includes mid-cap software priced for perfection. These are companies that may have less to do with consumption, but have valuations that leave absolutely zero room for error.
This cohort gets pressured purely because of expectation risk, and Elastic's performance brutally highlighted that risk for the entire high-growth sector.
The lesson from Elastic's 16% drop is undeniable then.
It is. It's that reporting a good but not great quarter, a beat on EPS but a slight miss on that growth acceleration narrative, it results in immediate, severe punishment for high multiple software stocks.
Let's quantify what we mean by priced for perfection. What does that translate to in valuation terms?
Well, when a company's priced for perfection, it means its stock is trading at a very high multiple of its forward sales, maybe 15 to 20 times its estimated revenue.
Which implies that the market expects continuous, uninterrupted revenue growth of what, over 30% for several years?
At least. So if a company valued like that only delivers 16% growth, the market instantly reverts to a lower multiple, say 10 or 12 times revenue. And that instantly causes a steep stock decline, regardless of how healthy the underlying business actually is.
So the gap between expectation and reality is the entire valuation penalty.
That's all it is. So if Elastic, which again still grew 16%, takes a 16% haircut, it drastically increases the perceived expectation risk for all its peers in the mid-cap growth space that trade at similar elevated valuation multiples.
Investors realize their margin for error is just razor thin.
Exactly. And the selling pressure spreads to companies like Cloudflare, ticker NET, the marketing platform HubSpot, ticker HUBS, and even the Zoom Video Communications, ticker ZM.
Now, these are all high-quality companies.
They are. But they are priced for flawless execution. And so investors are basically forced to ask themselves, if their next quarter isn't flawless, will they face the same fate as Elastic? And the resulting fear just causes proactive de-risking across the board.
This whole rotation is really something to watch because it proves that in the current market environment, the desire for stability and predictable subscription revenue far outweighs the enthusiasm for potential hypergrowth that's tied to usage volume.
It's a direct conflict between the potential of AI and data processing and the hard reality of enterprise budgeting. And right now, the market is choosing budget predictability over usage volatility every time.
This entire capital rotation mechanism can be summarized pretty powerfully. A shortfall against the immense aggressive growth expectations that were embedded in the valuation of one software company.
In this case, Elastic, ESTC.
It acts as a powerful, immediate catalyst.
And that catalyst instantly drives capital rotation out of the observability peers and the consumption models that share that same usage vulnerability.
And rapidly into durable, highly scaled platform vendors and the massive cloud hyperscalers that offer subscription predictability and budget consolidation.
It's a textbook reaction. It demonstrates a preference for platform stability over the volatility that comes with a niche solution.
The moment that growth narrative is questioned, the money doesn't hesitate. It seeks the platforms that can guarantee revenue, regardless of how much the customer tries to optimize their costs.
And that volatility, it highlights a crucial final thought for you, the listener. Reviewing these movements shows how extremely sensitive the market remains to the consistency of growth narratives in the technology sector.
The minute the underlying consumption model proves vulnerable to customer cost optimization.
That is, when customers successfully tighten their data belts, the market immediately reacts. It punishes those models, and it rewards the ones with fixed subscriptions and durable scale. Understanding this tension between consumption potential and budgetary reality is really key to navigating the software landscape right now.
We hope this breakdown of the capital rotation mechanism has been highly instructive. This information is not financial advice or a recommendation to buy or sell any security. This discussion is purely the opinion of the author of the source material and is provided for informational and educational purposes only.